Everyone, it's Simon, and I've been asked some questions lately about some options that I couldn't answer. So I'm doing some research on it, and I figured I'd make a video about it so everybody can kind of see how it works. So the question I've been asked is, what's the difference between in the money, at the money, and out of the money when it comes to price and profits, and which is better? So I figured I'd do a quick video on purchasing an option that's out of the money, purchasing an option that's at the money, and purchasing an option that's in the money. And then at the same time period with the same stock using the on-demand feature of Thinkorswim. And then we can do a comparison and see out of those three, as far as between cost and profits, which one is better. I'm going to do the call side this time, and then I'm going to do another separate video on the put side, and that way the videos aren't too long. So what we're going to do is we're going to actually be looking at Tesla. We're going to look at June 6th at 9:20 a.m. and it's going to be, and this is going to go till 10:20 a.m. But I'm going to use the fast forward feature so that way the video isn't like 3 hours long. And then we'll do a comparison on how everything worked out. So the first trade I'm going to make, this is paused right now. So the first trade I'm going to make is an out of the money call at 44 Delta and with a strike price of $215. And the cost of this call is, I'm only going to buy one. It's going to be $1,225. Now, I'm going to send this. It's going to take right away because we're paused right now. But as soon as we switch back over to the chart side, I'm going to start the on-demand feature, and then we'll switch back to this screen to see how the profits go. And like I said, I'll be fast forwarding every 10 minutes. So this is the out of the money call with a strike price of $215, and it's one contract of Tesla that controls, with the premium controls 100 shares. So here we go. So we push play and we'll head over to the chart. And I know this goes from 200, and right now it's at $4.12, and it goes up to 211 by the time it gets to 10:20 in the morning. So that's why we're using this, because I know exactly what it does. So we'll go back, we'll take a look at the profits and losses. We're at $27.50 profit right now. And we'll fast forward it 10 minutes to 9:30. We're at $80 profit. And then to 9:40, we're at $222 profit with a market change of $4.32 for the option and a market change of Tesla at $10.91. We'll fast forward 10 more minutes to 9:50, then to 10 o'clock, and then to 10:10, and then finally to 10:20, which is our actual where it maximizes. So we're at least pause that, and we're going to actually close the trade. So we'll just create a closing order, confirm and send, and we'll just double check. So our max profit, which would have been $15.90 if we had actually waited until the strike price was hit and closed out the count there, but we're not. We're actually just going to see what's at now. All right, so our profit for that was $385, and that was an out of the money call. So I'm going to reset everything, and then we'll do the next one. The account, we're back at $100,000 or $200,000 for stock buying. This is obviously a virtual account. We reset the time and date back to June 6, 9:20 in the morning, and we're still looking at Tesla. And this time we're going to buy a call, and it will be in at the money, which is right by where the strike price is. So the strike price is actually 205, and we are at, on the charts, at 204. So we're right at the money right here. And we're going to buy a one Tesla contract, and the cost will be $1,665. We'll send that. We're still at pause, so we're not, we haven't started anything yet. And now we're looking at a delta of 53. Before we were looking at 44. So if we start and start looking at the profits. So I'm going to fast forward this 10 minutes like I did last time. At 9:30 we're at 107. 9:40 we're at 282. 9:50 we're at 259. 10 o'clock we're at 247. 10:10 we're at 417. And at 10:20, which is where we stopped it last time, we're at 469. So I'm going to pause it again now. I'm going to close this trade out. And we have a profit of 469. So now I'm going to do this one more time, reset everything, and then I'll come back and we'll do one more trade in the money. Options purchase, we're going to buy a call. We're going to buy it in the money this time, which means that it's already met its strike price. The strike price is 190. And you're going to buy it at 67 delta. And I did that incorrectly. We'll go to the one right above it, which is the one I was actually wanting to do. There we go. We're going to buy one share as we did before. And we are going to confirm and send this. Now this one costs $25.35 for the option, and everything else is exactly the same. So we'll send that, it'll take it, and then we will push play, and we'll start from 9:20 again. So right now our profits are at 0. If we go 10 minutes forward, we're at 127.50. Another 10 minutes to 9:40. Another 10 minutes to 9:50. It actually dropped in profits to 290. At 10 o'clock, it goes to 292. At 10:10, we're at 485. And at 10:20, we're at 580. So let me pause that here. We'll close the trade out. And now we have comparison. So we're going to go over a brief summary of what actually happened, and then y'all can decide which one suits you best as far as trading goes. Okay, so this is the overview of what we learned from this video. So we started with out of the money, and it cost us $1,225 for one contract of Tesla. With a 44 delta. Our profit was $385, which gives us a 31.4% return. At the money, it cost us $1,665 with a delta of 55, and our profit was $469. So that gave us a return of 28.2%. And in the money, the cost was $25.35 for a contract. It was at a 67 delta. Our profit was $580, and that is a return of 22.8%. So the more you're out of the money, if you profit, obviously, you get a better return for your money. The cost is less and the profit is more, but there's always a chance that you might not hit your profit target. And there's always a chance that the stock will go back down, which means you'll lose. So I guess it's a matter of what you're willing to risk, and then what you can afford. Because out of the money at a 44 delta is less than half the cost of an in the money at a 67 delta. So based off of what we learned, then this is basically what your risk tolerance is and your cost of your contract. So I hope that helps clear that up. We'll be doing puts next. It probably won't be today, but we'll be doing puts eventually, and see how that works out too.